Hey, what's going on, everyone? I'm Sean from planningfire.com. Welcome to the only investment guide you'll ever need, part 3. Just as a heads up, a little housekeeping. Did you know that I now put out all of the audio versions of these videos as part of our Planning Fire podcast? If not, I'd love for you to check that out. It's a very easy way to consume this content if you're not always in front of a computer. All right, moving on. Welcome to part 3 of the only investment guide you'll ever need. This covers tax strategies. Tax strategies are a bit advanced, but honestly, it can save you a lot of money in the long run, considering the tax implications on your income. The lower you can get your taxes and the less income you can have taxed, the better, because you're no longer just lighting money on fire with income taxes. If you like this content, hit that subscribe button or hit the bell to get notified when I release new content. That way you can always be as in touch with me and this review series as I can be with you guys by putting comments in the comment box below. All right, let's move on. So it's incredible to think that now we actually have lower tax brackets than we have in the past. At the highest, there was tax brackets up to 50%, meaning for every dollar you recognize and you earned, you'd actually have to give 50 cents of that to the government. It's insane to think that it went up as high as 50%. Those tax brackets have changed quite a bit in the previous years, especially in 2018 and 17, with the current president-elect, who has raised the actual salary caps and lowered the tax brackets. But that said, 50% was its highest. So now they're still above 20%, as high as around 30-35 for federal, and then of course there's state taxes to consider. So for every dollar you make, you're giving away anywhere from a quarter to 35 cents just because you earned that money. So let's try to find some ways to shelter those taxes. Now we're going to talk about this in the perspective of the only investment guide you'll ever need. I'm going to lay out some tax strategies that he lists out here. So if you have kids, they're a great tax shelter. You can actually open a brokerage account for your children and put $1,050 per year tax-free into that account. Now, mind you, the caveat here is that your children will own this money. It's no longer yours, but it's a great way to start the brokerage mindset, the savings mindset in your children. Now, you can also put an additional $1,050 per year into that, only paying a 10% tax burden, which is substantially lower than your income tax would be. Great way to build a savings for your future. You can also provide them with up to $14,000 a year tax-free in gifts, and that could be children, grandchildren, and similar. Now, this is a big way that a lot of very wealthy people tend to take and move their estates to their children without having to pay taxes. So just something to keep in mind, up to $14,000 per year. The next item would be an educational savings account, again, for your children. This is also known as an ESA. You can put up to $2,000 per year per child or grandchild into this ESA. It can be eventually rolled into another account if it isn't needed for college fees or college tuition. And if it's not touched, it can actually be distributed as cash to your children and grandchildren only at a 10% penalty, including the growth. So that means you're only, once again, paying 10% on this investment, assuming it's not used for college. I don't know about you, but I've looked into college tuitions lately for different reasons, and honestly, that is getting incredibly expensive, even compared to when I went to college and grad school, where it was still very, very expensive. So having this plan for your children and grandchildren can be a huge benefit. Now, another option you can look into besides an ESA for college savings for your children is a 529 plan. The maximum contribution to this plan is 4 times the highest yearly tuition at any in-state school. You can reinvest the funds up to 2 times a year, and you can roll it into a different 529 plan once every year. Now, the recommended advice from the author is to put the first $2,000 of your investment into the ESA and the remainder into a college savings 529 plan. So you just have some options and some strategies. Now, of course, we cover the very obvious, very simple, and very advantageous 401k and 403b plans. As of this writing, you can put $18,500 per year if you are single into the 401k. It's normally allocated into stocks, bonds, and index funds. That's based entirely on your employer and who they choose to go through. Some will let you allocate to your own whims, others will not, so always keep an eye on that. And bear in mind, this is a pre-tax contribution. So if you're paying 40% interest, or if you're paying 40% tax on your income, you could actually take this and put it into your 401k tax-free up to that maximum per year. That's a huge income tax savings right there, and it's saving for your financial future and your retirement. The next item is the Roth IRA. You can put up to $5,500 a year if you're filing singly into a Roth IRA each year. Now, there are fairly stringent cutoffs as far as your income level to qualify for a Roth IRA. If you don't qualify, you can look into the option of a backdoor Roth, which we've written about here on planningfire.com. But just know, if you are under, I want to say it's an adjusted gross income of about $80,000 or $85,000, you can put $5,500, no consequences, into that IRA and use it as a tax deduction. Another option you have here is annuities. They do grow tax deferred, but you have to pay taxes when you recognize that income. They make a whole lot of money for the people who are selling them to you. That said, they are bad investments because, again, there's a lot of overhead and maintenance fees, there's brokerage fees, there's management fees, there's different costs associated with purchasing one of these. It's highly recommended that you find another vehicle. And then, of course, probably my favorite, he talks about real estate. Now, real estate is a tax shelter because the actual growth on income is tax deferred. You don't actually have to pay any taxes on the growth in real estate values until you recognize that income by selling the property and not rolling it into a 1031. You're able to claim depreciation on your real estate properties even if the value is going up, which is really interesting because essentially you're depreciating the house that sits on the land. So you can still claim that depreciation even if you're in a hot neighborhood that's doubled in value in 5 years. Huge tax shelter properties there. The growth potential on real estate is huge, especially if you're using it as rentals because other people are essentially paying your mortgage. You're earning increases in property values, which generally there's one thing that the world doesn't produce more of, and that's land mass. And then you're also getting your tenants to pay your rents and your mortgages. And then that way you're reclaiming all of that. There's of course a huge risk as well, but just know it's a great tax deferred, tax sheltering option. Now, one really interesting thing that he talks about in this chapter that I really want to push forward is that essentially you can teach your kids at a young age about investing and about savings by doing nothing more than matching their contributions from their little part-time jobs. So you can actually make contributions to your children's Roth IRAs indirectly. So if they have a job, let's say they're 14 years old and they're picking up their first shifts at McDonald's and they're making $100 a week. Now you can actually let them spend that $100 a week, or you can have them put that $100 a week into their own Roth IRA, saving for their future retirement. Now just think about the power of compound interest over the next 40 years as opposed to the next 20 years. It's huge. But then what you do is essentially give them $100 back that they invested. So you're essentially gifting them $100, which gives you a bit of a tax break, and then they're putting $100 into their Roth IRA, which could potentially give them a tax break, but they still have $100 to spend. It's a great way to get them interested in investing, teaching them about compound interest, and really setting them up for future success. Now, there's a lot more in this chapter that was covered. I highly recommend you read the book and leave any comments or things that I may have missed below. Until next time, I'm Sean from planningfire.com. I look forward to talking more with you about the only investment guide you'll ever need. Check that podcast out. If you want my content as soon as I release it, hit that subscribe button, or of course hit the bell notification icon so you can get notified as soon as I update these videos. Until next time, take care.